advising clients across the country. Here he is, your host, J. Christopher Boyd.
Welcome. This is Something More with Chris Boyd. I'm Chris Boyd, certified financial planner practitioner, and my office is Asset Management Resources. We're a registered investment advisor firm, and our show is a financial program. We call it Something More because we like to talk about not only those important dollar and cents issues, but also the quality of life issues that make the money matters matter. Thanks for being with us for our show today. I've got with me Jeff Perry in the co-pilot seat. Jeff, thanks for being here.
Always a pleasure. Thank you.
And we got a little bit of a good show planned here. We've got a variety of things we're going to talk about that are financial in nature in our first hour for sure. And then maybe we'll go into some of the something more in our second hour. To start us off, we've got Brian Regan, our firm's chief investment officer, joining us. Thanks for being with us, Brian.
Good to be here, guys. How are you today?
Amazing, right?
Yeah,
amazing. That's good.
I'm excited for the change in the clocks. Daylight savings time.
Springing ahead. That's right. Do not forget. You'll be.
I have to compliment you guys before we get started on last week's show with the bassist from Boston. That was a great interview. I loved it. It just made me think. I think Boston was one of my first or second CDs I ever owned. So.
Yeah, great stuff. I as a consequence of that show, went through listening to all kinds of Boston songs. Like, oh yeah, I love that one too. I was like, just kind of brought back a bunch of memories I hadn't listened to in a while.
That show should be up on our social media pages, hopefully, and our YouTube soon. So it's always a good option for people who hear us talking about things in the past to go either to a radio show podcast, right, Chris? The shows are on podcast.
Yeah, we got a variety of things going on now. So the podcasts are available pretty much anywhere you might like to listen to podcasts. If you're an iTunes podcast follower, if you like Spotify, even here on iHeart, the radio offering, you can find that just about anywhere you might listen to your podcasts. We're also doing our debut of a video. We got it on YouTube. So if you want to go watch the show on YouTube, you can do that as well. So I hope
you guys include that like off the cuff comments I made after we stopped recording by any chance?
We did. That was some of the best part, right?
Yeah. Warning to the listeners. I did not think that was going to be recorded, but it was.
Brian, don't you worry. We are recording everything you say, and we'll never use it against you, of course, but we have it all in the archives.
Will be entertaining, but certainly makes me a little nervous. It's nonsense. Bologna sauce.
That's what I was suggesting. Some of that kind of stuff. All right.
that may be. I mean, we have a long time to go. Many more, hundreds of shows to produce probably, but that's number one on the hit list right now. Bologna sauce.
Well, no one who was participant in that show will forget that one.
Well, so it's still relevant as that crypto bank went underwater this week, right?
That's right. That's right. Although it didn't sound like it was directly tied to crypto, but in terms of it wasn't. It was because of what it held. Was that what it was that it went under?
Yeah, it held crypto
stuff, but it wasn't
bologna sauce.
It's just the latest crypto-related entity to fall, right? I mean, that's how I look at it.
Yes, that's the way I look at it as well. One in a long string.
Mm-hmm.
Yeah, I think that's something we'll return to. I've been thinking maybe we'll try to invite someone like Rick Edelman on the show sometime and hear what they have to say about crypto these days. In any case, see if we can do that. But in the meantime, this week there was some market movement as a consequence of comments by Chairman Powell. And I was interested, Brian, to have you share with us a little bit about what was the nature of his remarks and why was it that created such a stir?
I don't know why it created such a stir. Quite frankly, he didn't say anything that the market didn't already know. He said that we had some surprised data that was more inflationary, which we've talked about in the last couple weeks on the show, and that that the Fed would raise rates in face of changing data. That shouldn't be a surprise to anybody, in my humble opinion. But it shot the expectation for a 50 basis point raise up from like 25% up to 75% in the next meeting. So,
to me that there's that expectation now. Tell us a little bit about inflation perception. What is the data that people are looking at? That's is it inflation related? Is it labor related? What's driving that expectation to the need to continue to raise at a 50 basis point pace after we're already up 4+%, whatever? I heard a commentator on a podcast, a bond manager, saying wouldn't be surprised if we get to a 6% Fed funds rate. So a real change in kind of expectation. I don't think that's widely held, but sort of a change in expectations on this.
Yeah, I think Jamie Dimon said something similar, that he wouldn't be surprised if it hit 6%. And without a rapid change in the data, it's quite possible that you could get there just with 25 basis points at every meeting. You could get there in the next, in this year.
Yeah.
It's interesting. I'll tell you what the Fed tells you what they're looking at. So they take food and energy and they basically exclude that, right? And they say, we're looking at core because there's factors beyond our control that impact food and energy. And then within the core, there's goods and there's services, and services make up about 70% of the economy, and goods make up about 30% of the economy. We've seen disinflation in goods, so that's the good thing. It rose rapidly as there were supply shortages, and it's come down nicely. Now, the services part of the economy, the biggest part of that is rent, and we know that new leases are declining. So if you sign a new lease, it's likely going to be less than it was a year ago. That doesn't necessarily mean that your rent today is lower if you signed your lease, 3 months ago. But the understanding is that if this trend continues, that rent will be lower and disinflationary in the back half of the year. So that leaves this small portion that the Fed is super concentrated on right now. It's about 28% of overall CPI, just to give you an idea of how small of a portion that is wagging, the dog here. And that is services X shelter. So services X shelter, you're looking at, things like transportation is a big one. Whether it be airlines, whether it be, Ubers, public transportation, things like that. Food away from home, bars, alcohol, things like that. So what the Fed's contending is that the biggest driver of inflation in this part of the economy is, in fact, wages, which I can't really disagree with. If the logic is, if we have to pay a cook at the local restaurant, $15 instead of $10, then the prices need to be passed on to the customer to defend the thin margins. That makes a lot of logical sense. So the wage pressures need to come down. Time needs to lapse, so we get the base effects, and then that will come down in time. We've seen wages come down a little bit, but not to the degree that the Fed is comfortable with. The labor market's still tight. All those things that we've talked about on a week-to-week basis. But I did find this one part of the services X shelter, which I found pretty interesting, that I think has almost nothing to do with wages, and that will likely come down in the latter half of the latter half of 2023. And did you guys have a chance to read this little thing that I wrote yesterday?
Did.
Yeah. So that part of services X rent is energy services. So they do exclude energy and food, but energy services are essentially your utility bills, your gas distribution, your electricity. That's what falls under energy services. And what's very interesting to me is it's a small part of overall CPI, almost 4%, but it's more than 10% of this small portion of the CPI that the Fed is super concentrated on. And that small portion is running at shelter X rent is about 7.2%. And your utility bills are up about 15.4% in the latest year-over-year bump. So you can see that this is driving a significant portion of that component that the Fed is concentrated on. And what's interesting about this is that the regulated utilities can basically pass on all the costs that they take on to you. So if they have to pay more for natural gas, for example, that's 100% going to be passed on to the customer. So during the war, through the spring of last year and then reaccelerated again in the summer, natural gas prices were very, very high. And so were coal prices and so were petroleum prices. And that all got passed on into your utility bills. Now the exact opposite has happened. Now they're very, very low. And if that persists throughout the rest of the year, which is no guarantee that it will, but if it does, then this portion that's a 15+% inflation reading is going to go to zero, and is going to be a drag of about 1.5% on that 7.2% portion that the Fed is super concentrated on. So that would be a big change, and something that the Fed is actively concerned about. And at the same time, we know that we're likely to have a similar base effects change in overall energy, which is part of headline. We know housing is going to come down, or we suspect that housing is going to come down. And then, in time, I think we should see some softening in the labor market based on rates here. So this is, what I'm trying to do is not necessarily react to the headlines, which is very tempting to do, but try to look forward and see, when and why will inflation fall in the future?
All right. So, Jeff, I don't know if you followed all that, but there was a lot of percentages that we were talking about in there. So my take from that is, in the guts of the way this is calculated, you're envisioning there are parts of this that are going to cause the rate of inflation to continue to decline. When we talked about this at our quarterly call for our clients, our webinar, as I think it was at that point, you talked about month over month inflation coming down pretty significantly, even more so than when we look at it year over year, from one month to the next. So if we annualize monthly perspective, is that still the case? Inflation is still coming down when we look at it monthly annualized, if you will.
Coming down from where, I guess is the question. Is it lower than the current reading of 6.4%? Absolutely. It's significantly lower. Did we have a slightly harder reading, especially in PCE, than we expected month over month? Yes. In CPI, it was still lower, but not as low as analysts were expecting. So the degree of slowdown inflation was not as aggressive as we would have hoped last month. But it still looks like that thesis is very much intact. Interestingly enough, that now that you bring that up, if I look at all items in the CPI, less food, less energy, and less shelter, right? So I'm basically saying core CPI, take out shelter because we expect that to fall. That's only 4% in the year over year numbers, right?
Yeah.
And, I think if inflation was at 4%, I don't think we would be generally that concerned about it, right? That seems like a number that's much more reasonable, still too high, still 2% too high.
But manageable. Yep.
But more manageable. So, food is certainly a big issue right now. I still think, and we do exclude it, but you have to consider it, right? I listened to a good analysis this morning about how even Pepsi and Coke almost used the Ukraine war as an excuse to pass on prices that they don't really plan on reining in anytime in the future. They're going to take the extra margin. And so have other retailers like Walmart has done this more recently. So, there's still pressures in the economy on price on things like staples, like food, for example. And I think that's definitely something to watch going forward. But, we're in much better shape today, and we're going to be in much better shape, in the summertime, I think, than we were 6 months ago, 9 months ago, for sure. And I don't think that should be lost on people, given any one reading or one headline. Let's try to look forward and be intelligent about our analysis.
Pardon me. When we look at the economic condition One would think if interest rates rise so dramatically in such a short period of time, that this would have a significant consequence. You know, we've thought that there would be, I think it's been broadly thought that there was a likelihood of a recession when we thought about this last year. Now we look at things and it doesn't seem as inevitable that there has to be a recession. Um, it's interesting to me that the economy seems still strong when you think about um, labor and the overall economic condition in the face of these rises in interest rates. I think it does suggest that you know, we might expect longer period of time where we're going to have higher rates. And you know, when you look at housing and you look at certain places, it's challenging as a consumer trying to find a house and pay a mortgage. But at the same time, we haven't had this in such a long time with the interest rate environment. But what is you know, a more normal you know, air quotes you know, kind of range for Fed fund rates? We had a decade of, you know, near zero, which was not normal, but it seems like the range we're in seems like it's in a more normal kind of historical realm. Is that true?
Yeah, I mean, I don't really think about it as normal or not normal. And I think you guys know the term artificial interest rates always perturbed me. Because I believe that the correct interest rate is the one where inflation is in check and unemployment's tight. So, you know, that means that the right interest rate in 2019 was, you know, near zero. There's no doubt about it. We had stable prices. We had a nice employment picture. You know, there's nothing wrong with that. That seems like a good situation to me. You know, the world changes, the economy changes. Now we're in a post-pandemic, post-war situation, or maybe not post-war, but during war situation. With changing geopolitical and globalization issues that we talk about a lot and continue to talk about because I think they're very important. And the new normal of interest rate isn't going to be zero in that environment, right? It's going to be higher, as we've seen today. We have full unemployment now, or full employment. I always say full unemployment. I misspeak a lot. We have full employment, but we have high inflation. So, you know, clearly the right rate is we haven't touched it yet, or maybe we have and it hasn't filtered into the economy, which is a tough situation to deal with, which is, you know, why there's so much argument about the Fed on a day-to-day basis. But I don't think the right discussion is you know, are we in a more historically normal rate? I think the discussion is what is the right rate for today's environment.
Well, I guess my point in bringing it up is that, you know, I think there's this perception that inevitably we're headed to recession, which, you know, you've written about this recently, you know, whether or not there's yet signs of recession or not. We talked about that previously, but the idea that just an interest rate, bless you, the interest rate being what it is, has to inevitably mean we are headed to recession. You know, I think that's sort of a change in mindset, you know?
Yeah, I think I'll repeat what I said last week. You know, the economy was super hot. Just because it was super hot doesn't mean it needs to freeze. It could go to temperate. And I think that's what, you know, the Fed's trying to do. We had maybe 14% nominal GDP for a little while. That's insane, right? We had 3+ real and maybe 11% inflation, depending on how you measure it, for a little while. And now, you know, we still have, call it, you know, the last 2 quarters would suggest that we have a 2% GDP. Let's say we have 6% inflation. That would be 8% nominal GDP, which is smoking hot. And there's no other way to put it. I mean, typically nominal GDP should be around, you know, 3.5. You know, that would say 2% of 2% of inflation and 1.5 of real GDP gets you to 3.5. A really good economy would be 4, and we're at 8. We're still really, really hot, and that's why employment's really strong, right? I don't really think you need to look much further than that. Now, that doesn't mean that we're out of the woods in a recession. And I won't say that, right? I did write about it, but my conclusion was, I don't think
Still
you
to
can
be determined. Yeah.
I don't think you can make a conclusion based on the data we have today, right? For the reasons that you've seen. We've seen housing starts, for example, fall off a cliff, but still relatively high compared to the last decade. So people are still building houses. I'm looking out my window right now. There's a house going up right across the street. So people are still building. We did see construction working, new jobs fall off a cliff recently, though. So those are things that, like, just keep in mind. Maybe that's the next ball to drop. I think the first ball to drop was tech workers. They call it the rich session, where high paying jobs have been getting axed first, and now it looks like there's certainly a slowdown, at least construction worker hiring. I still think we're in kind of a boom in leisure activities, and I think it'll be interesting to see if that's still the case come summertime. If you're still seeing, Norwegian cruise lines, for example, have great bookings, or Airbnb continue to do well. Things like that would be interesting to see. I think once you start to see that fall, then it'll come for the staples and the services that the Fed is looking to bring down.
All right, Brian,
I don't know if I answered your question there, if I meandered.
No, that was terrific. That was great. Perfect. We have to take a break. We're going to come back. Thanks for being with us for some of the show today. We're going to come back and talk a little bit about what's going on with Medicare and Social Security, and we'll be right back after this. Stay with us. Welcome back to Something More with Chris Boyd. Thanks for being with us. Coming to you from our studio here at the offices of Asset Management Resources. And of course, Jeff Perry coming to you from Florida.
I am.
Not bad.
It's a good place to be in March.
All right. Excellent. Well,
even though you're setting your clocks ahead an hour, as we are, we'll still be lighter later here.
Yeah, that's true. That's kind of a nice feature, huh?
It is.
More daylight.
Yep.
That's one of the things that I am happy about, though, is we'll be having lighter longer, as you said. I
wish they would. I know we're going to talk about some legislative stuff this segment. I really wish Congress would pass the Daylight Savings Time Elimination Act, or whatever the name of it is. It's been in Congress for, I don't know, decades, it seems like. And there's no one really disagreeing with it.
No one loves it. Yeah, no one wants.
They just can't. The bill has like 300 sponsors, and they just can't seem to say, let's do this today.
Because they can't do one thing. They have to throw everything else onto it, right?
In between hearings on why the Republicans are bad or why the Democrats are bad, whatever the flavor of the session is.
Be doing it today, yeah.
Can we just do this one? I mean, nobody, there's not even going to be a debate except people saying why they should do it.
All right. Well, aside from that, there is some important legislation that, proposals.
Yeah.
They're being bandied about. One of the things that we run into all the time is people talking about Social Security, talking about Medicare. These are things we take for granted as part of people's financial plan in their retirement. And people do often question, do you think it'll still be around, for Social Security more than Medicare in their discussion? Medicare's probably even in greater need of reform. But Social Security, I think, is the easier of the two to fix, and they call that the third rail, right? So,
you call it, if either side, it's usually the Republicans who are talking about it because they have some fiscal responsibility, republicanism, and all that. So, but who's ever talking about it, you can have the best intentions, but you get the blowback of even talking about it. And I remember when I ran for Congress in 2010. I was talking about, me and a lot of other people were talking about the need to do something. And then the next week there's postcards in the mail by my opponent saying, Perry wants to cut your Social Security. Of course, something I never said, but it's a third rail because it's politically dangerous.
It always ends up with that kind of an attack. They're making a lot out of your senator, I think it is,
Rick Scott.
Rick Scott, right?
And if people would take the time to listen to him actually talk about it, you would see he's saying the trust fund will be exhausted, and therefore there'll be a reduction. I mean, people know this; they've heard it enough. At some point, the current projection, I should say, by the Congressional Budget Office is Social Security Retirement Trust Fund will be exhausted by 2032, and therefore, if nothing was done, which won't be the case, but if nothing was done, benefits would have to be reduced.
25%, something along
Yeah,
those lines.
it's around 70 some odd percent of your current benefits. And that's just the math. That's not a threat. That's not a partisan thing. It's math.
This number of what year this will happen, this moves from one year to the next. I think in an article you shared with me and talking about this, they said it moved down 2 years over the last year's calculation, from 2035 to 2033, when you'd have this problem.
And now it's 2032. So it moved another year since that.
So, I mean, I think this is affected by a variety of considerations relating to employment and demographics, but this has not been something that's like new, a surprise. The exact date is in flux, but the math of this. I mean, I remember George W. Bush talking about the need to address this issue. What was that, like 20 years ago?
Well, yeah. So he was elected in 2000. So exactly.
Or whatever it was, maybe not
Yeah.
quite that, but you know what I mean?
Yeah.
Where there was this issue of like trying to address some need for Social Security reform.
And this isn't the first time. Congress has known this long before that. They had a major overhaul in 1983.
Yeah.
And at that time, Social Security was months away from
Yeah.
losing their ability to pay the full benefits. And we had some bipartisanship at that time. Those are the days of Reagan and Tip O'Neill and people who could actually sit down and talk to each other and work on things. And they agreed to do a number of things, which may be the solution. Like, again, in 1983, they raised the payroll tax gradually. And then they also raised the retirement age, full benefits from 65 to 67. So those are some.
What are the proposed solutions today? It is somewhat of a similar kind of two-tiered kind of suggestion, right? One involves more revenue. One involves that notion of, hey, people are living longer. Maybe they shouldn't retire as early.
Right.
Move the full retirement age again, kind of mindset.
So they're controversial, I guess. I mean, they're simple, but they're not easy. So you hit the nail on the head. You can either have more money coming in, meaning raise payroll taxes, which are now 12.4%. The payroll tax, and that's if you have an employer, that's split between you and the employer. A lot of people don't know that. They see it coming out of their paycheck.
Yeah.
And then they don't realize that their employer is paying the exact same amount.
Yeah.
Another way to get more money in is currently there's a cap on income, $160,000, about $200 exactly. And
this
so
changes from one year to the next. I think that
does.
is adjusted for inflation or something, where that number kicks in, where once you reach that maximum amount, you stop paying into the FICA on the income that exceeds that 160 now, 200.
And it's, it's a good question, like why, right? Obviously benefits are capped. There's a maximum Social Security benefit. So you could argue that if you reach a maximum Social Security benefit, should you be paying in more? This all goes, I'm going to go on a tangent. I'll come back. But a lot of senior groups, including my mother-in-law, she's not a group, but she's a senior, gets offended or upset when someone calls it an entitlement. An entitlement is something you get from the government, but she argues, and many of the retirement groups, the big ones, are saying this is, don't use that word. I paid into the system. I made a deal with the government. I paid in, and there's a formula, and that's that. So it's not an entitlement. It's something that I actually contributed to. So there's a side note on that.
Yeah,
But
I saw that, but it is, I mean, it's for that person, they are entitled to that. It
no,
is,
I'm with you. I'm just saying that, like, so
it sounds like it's a
sounds like it's a gift,
yeah,
right?
as opposed to, yeah, I follow you. Okay.
And so the debate or the discussion on saying there is no maximum income to contribute for additional payroll taxes is, well, there's a maximum benefit, therefore there should be a maximum contribution.
Would that change? Would that anyway? What I think it's my senator among those who
very different than my senators.
who is proposing this idea. Senator Warren is, and I think was it Sanders, Bernie Sanders as well.
Oh, I'm sure, yeah.
But they're proposing this idea that you, well, the old slogan of, well, those rich aren't paying their fair share kind of mindset that therefore you can tax more. And there's been different proposals over time, some where there's I'll call it a donut hole, like the healthcare kind of thing, but
the prescription drugs,
after a certain level of income, then you get reintroduced to the costs of contributing to the system for FICA, for Social Security tax.
So either the rate has to go up for everyone. We need more money in, just for sake of this discussion. So the rate goes up for everyone, or the rate is paid by some people above the income limit.
Or
so
that's the raised revenue side of it, right?
On the expense side of it, you could change the numbers again. You could, right now, the maximum age is 70 for the maximum benefit. The minimum age is 62. I could see a scenario where the 62 number slides higher.
Yeah, well, what they've done in this case, like when in the prior reforms, is they said, well, full retirement age is
right
65
to 67,
and they gradually moved it higher and higher so that eventually it's 67, and we're getting close to that point where people their full retirement age is getting closer to 67. And so if you start your Social Security benefits before that full retirement age, the full benefit number, there's a discount, and there's so much per month that you get discounted. And it works out to be about 30% from, if your full retirement age is 67 and you take it at 62, that 5 years ends up being about 30% of a discount. So, that's a hefty haircut to take, though you get to start it sooner. It's probably, Jeff, I would imagine they just do the same thing. You could still take it sooner if you needed to, but you'd get less and less as a percentage of the intended full retirement benefit.
It's an option. There's a lot of options in that formula. If you move the ages, then that's arguably a reduction in benefits, right? Because if you keep the same benefits but move the ages, it's definitionally a reduction in benefits. You'd be surprised how many people, well, you might not be, but our listeners might be surprised. Some 31% of women and 27% of men take Social Security at 62. So it's not an insignificant number of people who it is.
When we do these reviews with people as to when to, as part of their financial planning, when's optimal for them to take their Social Security benefits. Again, a big part of this depends on your life expectancy assumption.
Right. If you're ill or struggling with your health, and you're really, even maybe not able to work, the 62 option is the right option for some people.
It can make sense in those kind of circumstances where you may not live long enough to benefit from waiting, that kind of thing. But for most people, if they expect to live past early 80s, they are benefited by going for the maximum benefit, which is starting at 70, say.
currently.
Yeah, right. So in any case, these are things that you can evaluate just as an aside as part of your own personal financial planning. But
It's an important decision. It's a very important decision.
yeah, yeah. Let's continue this conversation. We went long in the first segment, and I'm getting a little signal. Maybe we should take a break. But let's talk about this and Medicare as well.
Right. Separate discussion. Yeah.
Challenges as well. We'll be right back. Stay with us. Thanks for listening to Something More with Chris Boyd. I'm Chris Boyd. I'm here with Jeff Perry. We're both of Asset Management Resources. Our firm, Asset Management Resources, is a registered investment advisor firm. We help people with their financial planning and portfolio management. Our primary focus tends to be with people near or in retirement, though we're happy to talk to anyone who might need some help in their financial planning or portfolio management. Along the way, feel free to reach out to us. You can learn more about our firm at amrfinancial.com. Appreciate you taking an interest if we can be of help. We offer a complimentary consultation, and we also have our show available to you not only through our podcasts that we mentioned, but also through various social media outlets. You can find us pretty much where you do your social media activity.
We're everywhere.
Yeah. So, Jeff, we were talking about Social Security. Bottom line is we really have to pay attention to this and address it. This becomes one of those things, as we said, politically, it's untenable. Nobody wants to deal with it, just because it's a hot potato.
It is, and
and there's a lot of rhetoric of suggesting they want to take away your, that kind of thing. When even if it's just someone's trying to be responsible with how do we solve this problem. I think for most times when there's proposals suggested about this, it's really something where it probably won't directly affect people who are 50 and over in whatever solution they come up with.
absolutely
When it comes to their benefits. It's probably more likely it affects people under 50. Sorry, Armin, on our team here. The likelihood of that is probably more likely that there'll be some consequence for how their benefits are calculated and so forth. On the other hand, for your point about taxes and revenue raising, the air quotes for the euphemism for more taxes, that's very likely to affect people right away, and to however they define this, who they're going after.
Well, they've got 10 years for Social Security, if you believe the projections. I'd like to see
a change, but it appears to be sliding or changing.
Right. Well, if you take out the COVID period, which we lost a lot of our loved ones and seniors, certainly that set back some life expectancy numbers. But if you take that period out, we are living longer. Absolutely. I'd love to see a real serious effort taken on this subject and Medicare that we'll talk about in a minute. But, maybe the approach is for Congress to appoint a number of senators and representatives from both parties, both chambers, blue ribbon commission, if you will, and come up, people who are sincerely interested in the details of Social Security reform, not people who are just in it to throw bombs, and come out with a report, a suggestion, a unified suggestion that both parties can agree on, and make a recommendation to Congress that they could have an up and down vote on. That would take some of the bomb throwing away from both sides if there was a bipartisan commission to make some suggestions, because if they do nothing, they fail. They all fail. Everyone in office, they fail. And I'd also like to see, as part of that sincere study, a real look at SSDI, Social Security Disability Insurance.
Yeah, that's already in jeopardy in terms of its cash flows, isn't it?
Yep. There's over 8 million people in the United States on some form of SSDI. And if you just Google SSDI fraud, the stories are endless. about people taking advantage and the lack of oversight and the lack of follow-up and the lack of just good management in the system, where identity fraud, people are on it, that people get on it, they get better, but nobody follows up. In addition to taxes, which might be part of the solution, in addition to benefit changes, which might be part of the solution, we got to make sure that people who are not entitled to entitlements, SSDI would be an entitlement, aren't getting tax dollars that should be spent for people who actually qualified for benefits based upon their work. Now, certainly there's a number of people that need to be on it, and we want to have that safety net. But like all programs, if money's going fraudulently to individuals, it takes away from the people who actually need it.
I will say though, I have a client right now who's struggling to get disability. Their doctor says, you can't work.
Sure.
They have disability. They're unable to qualify. They have to, go through this. I forget, it's a court process or an appeal.
It's quasi-judicial, absolutely.
And it's just been the struggle, Now,
It's,
how is your bipartisan commission different from what was it, the Simpson Bowles commission of a decade ago? Wasn't that sort of what they were tasked with?
they were,
And
but
nothing came of it.
nothing came of it. So
I mean, but is there really a point? We already have the commission. We already have the results. And nothing comes of because we can't get consensus in Washington to actually do something.
well, it would take a commitment from the leaders, both parties, both chambers, to put this to the floor. Maybe I said it in my comments, but maybe I should have emphasized it. A commitment to put it to the floor for a vote. People change when they have to push a button. I saw that with my 8 years at the State House. They have a lot of rhetoric, but when they actually have to push a button, yes or no, and vote against or for something, they become a lot more informed and a lot more accountable than just I'm against this, I'm for this, when there's nothing to vote on, or it's done just, in the middle of the night without a roll call. So if they could agree to have the commission, whatever the commission recommends, for a floor vote without amendment, I think that would have a different outcome. I don't know if it would pass or not, but I think it would.
Well, this brings us back to, I know this isn't our planned conversation, but it brings us back to the whole thing with the risk of government shutdown and the
debt ceiling.
Ending.
Same thing.
It's like all these kind of negotiations that, how much is in good faith and how much is political posturing, right?
If it's anything like the State House, it's more on posturing and talking to your base and talking to your fundraising groups than it is on getting substantive answers for the good of the country or the good of the state. I mean, I don't think it's that different, Chris. It's not what I want to say, but that's the truth. And if you talk to people who have been senators and members of Congress and are no longer, they'll privately tell you it's the truth.
Yeah.
It's discouraging, but it doesn't mean we give up. It doesn't mean we stop holding our elected officials accountable. I mean, it's easy if you ask a question to an elected official, it's real easy when there's nothing for them to actually vote on to tell you what you want to hear.
Right.
But when they have to push a button and vote for or against something, it gets real serious in the chamber when people are like, oh boy, this is on record now. I told this guy I was doing this.
Yeah.
Now I got to push the button. Yes, I've told people I'm going to do it. We can be optimistic.
We've got 3 minutes to solve the problems of Medicare.
Well, President Biden thinks he can solve the problems of Medicare. And, I don't particularly agree with his outlook on it, but let's talk about his plan. He wants to increase taxes as part of his 2024 budget proposal, which should be coming out. I think it may have come out the end of this week or maybe next week. He wants to increase the net investment income tax, one of your favorite taxes, Chris, from 3.5 to 5% for earnings of more than $400,000, which would include.
I think it's 3.8 now, actually.
it is. If I said 3.4, I misspoke. 3.8 to 5, which would include your regular income, your capital gains, and the so-called evil pass-through business income, just to get you going, which flows to income tax returns.
Just to get me going. All right, we're going to talk about this in the next hour.
All right.
'Cause, I mean, we can get this started, but that's, I mean, there's still a lot to talk about in there that we want to address, right? So I think he's talking about negotiating with prescription drug companies to try to save costs as well. Is that correct?
Yes, he wants to expand what was passed in the Inflation Reduction Act, which had a component of negotiating. He wants to enhance or expand that ability to negotiate prescription drug prices beyond the Inflation Reduction Act. So there is a lot to talk about. Part of a
budget negotiation, though, really. This is it doesn't sound like I mean, this is he had a better shot of passing things like this in the last Congress than he does in this Congress. Isn't that the expectation, that this is kind of not really going anywhere?
So here's my rhetoric. So this is part of his budget proposal that he wants to be able to say in his budget proposal, he has deficit reduction. And so deficit reduction, back to this, means bringing more money in or cutting programs. So if he increases taxes, which he would do in this budget proposal, he can say, in my budget proposal, I have decreased the deficit.
Yeah.
And in the footnote, it would say that the CBO, the Congressional Budget Office, estimates this new tax at whatever, not disclosed yet, and therefore the deficit would be reduced. But to your point, the Republican-controlled House will never vote for a new tax like this without other considerations on spending.
Jeff, do you want to talk more about this in the next hour?
That's totally up to you. I know I pushed a few buttons on things on you.
Let's at least touch on it.
We should explain it, I guess, a little bit.
Yeah, we'll take a break for the news, and we'll be right back with another hour of Something More with Chris Boyd after this.
You're listening to Something More with Chris Boyd, financial talk show.
Asset Management Resources, LLC, and J. Christopher Boyd, CFP, provide investment advice on an individual basis to clients only. Proper advice depends on a complete analysis of all facts and circumstances. The information given on this program is in the nature of general financial comments and cannot be relied upon as pertaining to your specific situation. AMR, LLC cannot guarantee that using the information from this show will generate profits or ensure freedom from loss. Listeners should consult their own financial advisors or conduct their own due diligence before making any financial decisions.